At Hammond Iles Wealth Advisors, we call ourselves financial coaches. Many firms call themselves financial advisors, financial planners, but for us, we are financial coaches. And the reason for that is not only because we feel that we help people achieve more and see more potential in them than they may see themselves, but also because as a coach, we stand next to you in challenging times and coach you through different experiences, just like the one today that's leading us to have this financial power hour on the state of the markets. So over the next roughly hour, we're going to talk about the state of the markets and how the current environment is situated and how you can invest with more confidence in your investments or maintain the confidence in the investments that you already have. Now, Hammond Iles Wealth Advisors is a registered investment advisor. So we operate on a fee basis and are a fiduciary, putting our clients first. Just want to make sure that you're aware of all the disclosures that we're required to share with you at the beginning of this presentation. And we will be accepting questions throughout the presentation. If you have a question about a particular slide or something that I'm sharing, feel free to put a question in the chat. And today we will take a little bit of a look back as a foundation to realize kind of where we are today. We're going to look at how did stocks perform in 2024, what drove that market performance, and where are we now? And what are major firms forecasting for this year? And lastly, what can you do and how can you invest with more confidence in these uncertain times? So let's talk a little bit about the past to lay the foundation for our conversation today is how did stocks perform in 2024? Well, it was very interesting. At the end of 2023, the Standard & Poor's 500 index, which is an index of the 500 largest companies in the United States, it's typically used as a benchmark of the overall stock market, but it does just represent those largest 500 stocks. And different investment companies gave their best estimate on where they thought they would end up for 2024. And what we found is a couple of them thought that the markets would actually go down last year. And several of them estimated that it would go up just kind of an average year, on average around a 6 to 7% return for 2024. So now that we're in 2025, how did they do? Well, as you'll see, they were completely off. We ended 2024 with the Standard & Poor's 500 index at 5,881, a significant increase above and beyond what even the most optimistic financial firm thought for 2024. So it just goes to show you that although many people will try to prognosticate or estimate or predict the future of the markets, no one really has an idea on what the markets will do. So then, looking ahead at what drove that market performance, why is it that the markets did so well in a year when many predicted just an average year? And so when we take a look at that year, we started out the year with the Consumer Price Index, which is used as a measurement of inflation, starting the year at around 3.4%. Now, that is above the target for the Federal Reserve, but yet it's down from where we were in 2022 at the peak of our inflationary period. So there was some optimism about inflation, and that led to the market starting to go up at the beginning of the year. We took a little bit of a pause in April as the markets pulled back a little bit, but then resumed the march forward, going up in all the way through July, where inflation hit 2.9%, a three-year low. However, unemployment at that same time started to creep higher, And although it had been relatively flat for the last almost 3 years, it started to tick a little bit higher, and that caused some pullback in the markets. And then in September, as the markets and the economy did show strength, the Federal Reserve cut interest rates by 50 basis points, or roughly 0.5%. However, we did start to see inflation pick up a little bit in October, and so there was a little bit of pullback. And then in November, we all breathed a sigh of relief that finally the election was over. Whether you were happy or disappointed with the outcome, the markets were happy to just have that national election behind us. And the markets took off in November. And as inflation was still being stubborn, showing signs that most likely the Federal Reserve would hold tight on interest rates, we saw the markets sell off a little bit in December. But overall, the Standard & Poor 500 index had a fantastic year after a previous year in 2023 of a very good return as well. And one of the driving forces of that, we're looking at the quarterly earnings of the companies within the Standard & Poor 500 index. In 2023, we actually went through an earnings recession where we had 3 quarters in a row where the earnings of companies within the S&P were negative. If we have 2 quarters in a row, that is the earnings recession, similar to a general economic recession, which is measured by the gross domestic product or the measurement of the productivity of our economy going negative for 2 quarters in a row. However, you'll see that going into 2024, starting in the fourth quarter of 2023, we started to turn positive again and grow some momentum of corporate earnings increasing. And although in the third quarter of 2024, it pulled back a little bit, still a very positive 5.8% year over year. Also, when we take a look at other measurements of the economy, showed very strong aspects, growth throughout the year with our economy as a whole. Also, the unemployment rate, although it did tick up, it ticked up from a 50-year low of 3.8% to 4.2%, of still historically a very low unemployment rate. And inflation, the big concern of prior years, gradually started to come down. And we started to talk about the fact that did the Federal Reserve actually plan for and accomplish a soft landing from the spike of inflation? Optimism amongst consumers as well as builders held up strongly throughout the year. And consumer sentiment is an extremely important factor since consumers make up 2/3 of the U.S. economy. So number 3 is, where are we now? So we've had a really good year in 2024. We're just into our 3rd month of 2025, so where are we this year? Well, taking a look at economic indicators, one measurement is taking a look at this dashboard of 20 different things that can impact investments and the economy. And you'll see that in January of 2023, there were no green or positive gauges on the market. Actually, we had a significant number of red gauges and just a few yellows. We had 7 red and 13 yellows out of those 20. So it wasn't looking really good. But as we moved into 2024, the needle started to move in the right direction. That year, although we still did not have any positive green dials on the chart, we moved to having only 3 negative and the other 17 in a neutral stance. And as we entered this year, we moved even more in the direction of a positive economy. Nearly half, 9 of the 20 dials on this indicator showed that we were in a positive position. We saw the labor market positive. We saw interest rates starting to come down. Consumer sentiment is still very positive. Business spending was holding up. Inflation is coming down. But yet there's still some red areas in the market. So there are some things that we have to be aware of, but we certainly started out this year in a good place. Now, one of the things that may cause us pause is just looking at the leading economic indicators. So this is one of those 20 dials that we look at. The LEI looks at 10 different metrics in the U.S. economy as a leading indicator. For example, manufacturing orders. Are they going up, going down? That's a leading indicator of what's possibly to come in our economy. And you'll see that starting in 2022, when we spiked with inflation, that the leading indicators started a trend downward. And the LEI has been accurate at kind of predicting the last 3 recessions in the economy. But like all other metrics and tools, nothing is 100% correct all the time. And actually, although it's very difficult to see on this chart, in November of 2024, that line actually started to turn back up. It increased by 2.5%. So the question is it starting a trend back up, or is it just a little bit of a head fake before we trend lower and have the start of a recession? Again, nobody can predict the future, so we're not going to try to predict it ourselves. But we want to share with you kind of some of the information so that you can just be aware of what's going on. Because the media has a way of just showing the negative parts of what's the picture, because we all know that as humans, we will click, we will watch, we will read more with a negative headline than we will with a positive. So you probably will see these potential headwinds as headlines in our media. That there's a resurgence of inflation, that there are recessionary pressures, that we're heading for a recession. There's geopolitical uncertainty, both in Europe and the Middle East, that there is a labor market weakness, and that there are continued trade tensions, especially with actions of the new administration. However, we do have some tailwinds that continue to push in the right direction. They may not be talked about as much in the media, but artificial intelligence, although there is some challenges with kind of figuring out exactly how it's going to apply to what we do, artificial intelligence is a positive tailwind to our economy. It is improving in efficiency, allowing us to accomplish some things faster if it's used properly, and we're still kind of figuring that out. Monetary easing is continuing to find its way. The Federal Reserve will be meeting soon and may talk about lowering interest rates further. And as we showed previously in the presentation, corporate profits continue to improve. Now, one of the other ways that we can measure potentially the future of the markets, or take a snapshot of where we are, is taking a look at what's called the forward PE ratio, or profits divided by earnings. And historically, that ratio has been equal to about 16.9 on average if we look over the last 30 years. However, at the end of 2024, that PE ratio was up at 21.6%. And so it is on the high side. So is that predicting an opportunity that the markets will go down to bring that ratio back in line with the historical average? Or are we going to see corporate profits continue to increase to help bring that ratio back down? It will take a path of one way or the other. Could be the combination of the two, but it is one metric that we keep an eye on and take a look at. It's one of the reasons why we have expressed concern about the Magnificent Seven large technology companies that make up close to 30% of the Standard & Poor's 500 index, some of which have valuations up over 50 times their earnings, and that there may be a reckoning coming for those stocks. So now we've taken a look at 2024, kind of looked at where we are now at the beginning of 2025. So what are some of the forecasts for 2025? Well, again, looking at those earnings, looking at how we're going to find our way of that PE ratio coming back to our historical average. Certainly, an analyst looking at the Standard & Poor's 500 index companies looks as though they're projecting earnings to continue to grow through this year. Also, the market, as they take a poll of what different individuals are predicting for the federal funds rate by the Federal Reserve, there's a 45% chance, or 45% of them are saying that most likely the Federal Reserve will reduce interest rates by 1/4 point by mid-June. Currently, we're at 4.25 to 4.5, and that will go down to 4 to 4.25. There's actually even a 28% chance that they may leave it the same, and also around the same percentage that it could actually be cut even further. When we take a look at another measurement of the economy, the gross domestic product, what we see is that we continue to remain with a positive growth of our economy. Now, in order for us to go into a recession, as I mentioned, we would need these numbers to go from their positive almost 2 to 2.2% all the way down to being negative numbers in 2 consecutive quarters, which would be a substantial decrease in economic activity. And with unemployment, it's projected that we're still, although we may see it creep a little higher, that it will remain around the same for this year. Now, with the recent activity of the current administration reducing the size of our federal government employment, that may influence this figure as well. We'll see how that plays out. As I mentioned, one of the drivers of the economy is the consumer. And so we pay attention to what consumers have both on liquid wealth as well as credit card delinquency. These two can be some of those leading indicators. And what we saw is that during the pandemic and in the late 2019, we saw a spike in savings. We weren't doing quite as much. We were feeling comfortable with our income and banking more of that into savings. But over the last few years, we've seen those savings diminish. On a positive side, though, since the peak of inflation in 2022 and starting in 2023, we started to see those savings start to trend upward again. However, probably one of the more concerning aspects is that we have seen the number of delinquencies of credit cards increase dramatically over the last 2 years. So it's showing that although consumer spending is staying up, is it going to be able to be sustainable, especially if people have been charging it and carrying credit card balances over the last couple of years? So what's ahead for short-term interest rates? Well, the Federal Open Market Committee will meet 8 times this year. The next one coming up next week on March 18th and 19th. So we'll stay tuned to what the Federal Reserve will predict, whether they will continue to hold their stance and wait for potentially the May or June meetings to take action, or whether they may feel comfortable enough with the economy that they may reduce interest rates at their meeting in March. Now, for those big firms, again, despite completely missing the pitch for 2024 and striking out, that's not going to keep them away from the plate. They're going to take another shot at it. And so they are predicting that the markets are going to go up this year. Again, the year ended in 2024 at 5,881. And so the average group consensus is around 6,600, which would provide a growth of around 11 to 12% for the calendar year. So hopefully they're right that for once that they may get that close. Perhaps it'll be like 2024, completely proven wrong, either by going up dramatically wrong more, or could be the opposite direction. We'll have to wait to see. So if we can't trust the big financial firms to predict the future, and there are so many different economic indicators that point in different directions, how are we supposed to navigate the future of 2025? Because it's important that you come away from this conversation with more confidence about your investments in going forward. And that's what we're here to do, is to share our core principles of investing and how knowing what you're invested in and why, will give you more confidence through your investments through these uncertain times. Now, one of the things that we hear frequently is a complaint or a cheer for the current administration. And whether you're for or against the current president, and whether you voted for or against him, one of the things that you need to be aware of is that stocks trend higher regardless of a president's party. If we look back to the 1920s, the markets have generally trended up, and this again is looking at the Standard & Poor 500 index, no matter who's in the White House. Despite the challenges of different policies, administrations, and regulations or deregulations, companies will find a way to continue to make a profit. That's what they're in business for. And so the economy and the markets will continue to trend upward. You will see ups and downs over that time frame, but the general trend of the market is up no matter who's in the White House. Also, when we take a look at the markets, it's also important to understand that down years are just part of the process. But it's also important to know that down years are the exception to the rule. If we take a look over the last 96 years, looking at 1 year periods of time, 73% of them, 70 out of 96, were positive returns in the market. Whereas only 27%, roughly 1 out of 4, were negative years in the market. If you were to buy a scratch-off ticket or go to a casino where you had the opportunity to win 3 times out of 4, I would say there would probably be a line. People would line up with those odds of knowing that they would have a positive return 3 out of 4 years. But the amazing thing is that's just looking at 1 year. If we extend the time frame, which we should when we look at investments, it's a long-term investment commitment. If we look out over 3 years, looking over 3 rolling years, that probability of success or positive return goes up to 84%. When we extend it out farther, looking out 5 years, it jumps up to 88%. Almost 9 out of 10 years, or 9 out of 10 5-year rolling periods are going to have a positive return. It's one of the reasons why no matter who's in the White House, the markets tend to be up when they leave than when they came in, is that the markets have a 90% chance of over that 4 or 5 year time frame, or potentially 8 years, depending on the term, that the markets are going to be higher. If we look out over extended that even further over 10 years, it gets up to 94%. Now, sure, yes, there is the odd of having a 6% that there could be a negative return, but 95% of the time is going to be positive over a 10-year time frame. And there are other steps that we can do to tilt these numbers further. One of the main ways that you have to take advantage of those 3, 5, or 10-year numbers and probability of success is that you have to stay invested. And that hopefully is going to be one of the messages that you take away from this Financial Power Hour, is that it's important to stay invested. And this analysis shows the impact of being out of the market. The challenge with being out of the market is that you have to be right 2 times. You not only have to be right of when to get out of the market, but you also have to be right of when to get back in. Many times when people get out, they just don't have the confidence to ever get back in, and they lose the power of compounding in the financial markets. If you invested $10,000 in January of 2005, and you let it grow for the next 25 years through the end of 2024, you would have earned an average of 10.4% in the Standard & Poor's 500 index. Again, it's an index of the 500 largest companies in the US. That $10,000 would have grown and compounded and would be worth just shy of $72,000 at the end of 2024. Now, over those 25 years, that's over 5,000 trading days. So the question is if you missed just 10 out of 5,000, your return would have almost have been cut in half. That $10,000 would have only grown to $32,871 to average 6% versus staying invested. And that's being invested for 4,990 days, but just missing the top 10. And you can see as you look down the right side of this chart, missing more of the best days in the market, whether it's 20 days, 30 days, going out, missing 40, 50, or the top 2 months out of 25 years, you would have actually had negative returns because you missed the best of the markets. And I think this chart, the best thing here is this little box that talks about the fact that 7 of the 10 best days in that 25-year period occurred within 2 weeks of the 10 worst days. So if you're using a worst day to get out, you're going to miss one of the best days, most likely. And that 6 of the 7 best days occurred after the worst days. And the second worst day of 2020, which was March 12th, was immediately followed on March 13th with the second best day of the year. And if you use that worst day to jump out, you missed it. And your return would be greatly reduced. So I hope that what I am driving home for you today is you need to stay invested. Now, the other aspect of that, which we'll talk a little bit about with staying invested, is the ability to earn over time. Just like we talked about, the probability of success goes up by staying invested over 3, 5, or 10 years. The same holds true when we start looking at the total return of your portfolio over that period of time. In this, we kind of refer to as the funnel or range of stock, bond, and a diversified portfolio return. So the green bar, which represents stocks, using, again, the Standard & Poor's 500 index, if we look at just 1 year, you have a range of returns anywhere from a positive 52% to a negative 37%. That is a really wide range when you look over just a 1-year time frame. For bonds, that range, because bonds have less fluctuation, is smaller, and a diversified portfolio of 60% stock and 40% bonds is going to have somewhere in the middle. But the amazing thing is that when we stay invested over a longer time frame, that range of returns pulls in and narrows. Over a rolling 5-year time frame, being 100% in stock, your range now dials in that worst case scenario over the time frame looking from 1950 to 2024, those 75 years. Worst case rolling 5-year time frame was a minus 2%. but the best was a positive 29%. And if you had a diversified portfolio of 60% stock and 40% bonds, you didn't have a negative return. Worst case scenario is that you were a positive 1%. And as we go out further, that those ranges will get smaller. It's kind of what I refer to as kind of the return funnel, that we stay in and the funnel narrows. However, just like if you get out of line at the grocery store or you get out of line at an amusement park, you got to get back in line at the end. There's no cutting. So if you jump out after 4 years, you're right back at the beginning of the funnel and you've reopened the potential returns of your portfolio again. So it's important to stay invested and work through the return funnel. Now, related to that, just like we talked about the fact that you can have the benefit of being invested in both stocks and bonds in a diversified portfolio helps to mitigate risk while still providing good returns over time. Also, part of being diversified is being globally diversified. And over the last several years, we've heard the call of, why are we investing internationally? The US is doing so well, why bother investing internationally? Well, here's a chart looking at world market indices up through March 10th of 2025. And what we see is the Hang Seng Index in Hong Kong is up over 21% for just the first 2 months and 10 days of this year. The DAX index in Germany is up 12.6%. The CAC in France is up just under 9%. The FTSE in the UK is up 4%. Shanghai up 3%. Even though the S&P 500 index is down 4%, the world markets are up. And so I would encourage you, if you're reading the headlines or watching the news and you're concerned about your investment portfolio, log on to the Hammond Iles website and take a look at your portfolio. I think you would be pleasantly surprised at how well your portfolio is holding up through this uncertain time frame. Because of the diversification, both using stocks and bonds, as well as investing globally in the US and internationally, you're getting the benefit of these stock markets that are performing well this year. So it's important to understand broad diversification, that you're globally diversified, and that you're also at a level of risk that you're comfortable with the level of bonds that we're using within your portfolio. So what are some action steps for you to take for 2025? Well, the first step that we encourage everyone is, if you're working with Hammond Iles Wealth Advisors, keep us informed about important life changes, whether that's changes to your employment, whether it's retirement, whether it's the joy of an additional member of your family. Let us know what is happening in your life and whether that needs to change your financial planning going forward. The second is, don't let emotions influence your investment decisions. It is very easy to watch the news, hear the negative headlines, and immediately think that I just need to sit this one out. But hopefully what you've learned today is that that does not make sense. Although the markets are down in 2025, the value of the S&P 500 index as of yesterday, March 11th of 2025, is the same value that it was on September 11th of 2024. So by buying into the market, now you're basically just buying stock at a value that it was 6 months ago. You still have had 2 tremendous years in 2023 and 2024, and you're still well ahead of the game. The third is, I would encourage you to balance your media consumption. One is to make sure that you're taking in information from different sources. Unfortunately, in this day and age, there is a lot of news that's out there that is not correct. So by taking in information from different sources allows you a better opportunity to learn what's really going on in the world, as well as what the truth is or what's actually happening, rather than a spin of one side or the other. Also, if you're finding that the amount of news that you're watching is causing you angst, anxiety, concern, turn it off. Stop reading it. Don't go online. I'm not saying to bury your head in the sand, but perhaps you need to go on a media diet. We need to cut back and utilize the news that you need to have to stay informed, but not so much that it's going to ruin your day. Now, I also want to share with you the steps that we are going to take at Hammond Iles Wealth Advisors. The first is that we are going to keep you informed through regular communication and continued education like today's Financial Power Hour. The second is that we're going to continue to follow our investment philosophy, dedicated to academic investing principles, that you own equities, that you are globally diversified, and that you systematically rebalance. Thanks to the new technology that we've put in place with our investment portfolios, our allocations are reviewed every 31 days. We work to manage the level of risk in your portfolio, so when the market pulls back like this, it should be seen as an opportunity. You should be celebrating. I'm going to sell some bonds and buy some stock while the market's down. So when it does recover, at some point in the future, when it will recover, I will recover faster because I bought more stock when it was down. Same thing like we did in 2023 and 2024. When the markets are high, we're going to take some of that profit off the table. We're going to rebalance, sell some stock, and buy more bonds. Both of those actions go counterintuitive to the emotions of the time. Things are going well, so why shouldn't we ride it? Things are going bad, so why shouldn't we sell? Because prudent investing has shown, being committed to the long term, that we sell high and buy low. It's the golden rule of investing, and that's what rebalancing does without emotion. And the third is that we're going to continue to be your financial coach, providing coaching by addressing your concerns and trying to counteract the media messages that are out there. So we are here as your financial coach to stand by you. If you have concerns that are weighing on you, keeping you up at night, watch this video again over and over again. It'll be on our YouTube channel, or schedule a time to come in and talk with your financial coach. Let us coach you and be along your side to help you through this uncertainty. So again, I just want to thank you for taking some time out of your day to join us. For those of you that may not be current clients of Hammond Iles Wealth Advisors, I just want to take a minute to talk a little bit about how we can help. As I mentioned, we're financial coaches, and we offer a free conversation with any of our coaches. You can go to our website at hiwealth.com, and you can click on a button in the top right corner to schedule a free conversation at your convenience. At Hammond Iles, we're also different in that we believe that everybody started at zero, and so we have no minimum investment amount. So whether it's your grandchild or whether you yourself are just getting started, know that there is no line to be drawn on you being able to work with us. Also, we continue to offer these online financial power hours. You'll see them on our website, on the events page, as well as shared throughout our social media. And if you're not able to attend any of them or want to see some of them again, you'll find all the recordings of our power hours on our YouTube channel. I also encourage you to follow, connect, or like us on social media. We not only share continued conversations and communication about the markets through our social media, but we also share a 60-second weekly message called our Financial Friday. It's shared out through our social media and on YouTube, just a single message for that week that we want to share with you. And last, also on our website are a whole host of resources. One which I would like to highlight is our Family Inventory Workbook. It's a single document that allows you to organize all your finances and information in one document. So if something happens to you, or if you're incapacitated, that your friends or family members can pick up that document and know exactly what your financial picture looks like so that they can assist you or take on implementing your plans for transferring wealth to the next generation. So all of that's available for free on our website at hiwealth.com.